Hi, I'm John Nicholas. Stock markets are at all-time highs and bond yields are at historical lows. In this video, I discuss considerations on allocating your investment assets in the current market environment. Interest rates are at near all-time lows. The Federal Reserve has pushed down interest rates and has indicated it plans to keep rates low for some time to come in order to prop up the economy, which is recovering from the COVID crisis. You can see in this chart that the yields on U.S. Treasury bonds are below 1% out to 7 years and just over 1% for the 10-year Treasury. These yields are significantly lower than they were a year and a half ago. In addition, what you earn on a 10-year Treasury bond, for example, is below the rate of inflation. Over time, the purchasing power of your money, that is what it can purchase in goods and services, declines as inflation outpaces the return on your bond investments. You can also see in this chart that relative to the earnings yield on large cap U.S. stocks, yields on investment grade bonds are close to 40-year lows. Investment grade bonds therefore are unattractive given their current low yields. They are also exposed to the risk of higher than expected inflation. It is possible that interest rates could go down further and therefore produce positive returns as they did in 2020 when rates declined during the start of the COVID crisis. However, given the current rebound in the global economy, massive government deficit spending going forward, and rapid expansion in the money supply, the more likely path is that interest rates will increase as they have been recently. Increased interest rates would cause negative returns for current owners of longer-term bonds. Higher yielding junk bonds are not a refuge from low yields, as the average yield on these bonds also has recently dropped to below 4%. Yield-hungry investors have been buying up junk bonds, and the demand has driven down yields. Stocks are also trading at historical highs, both in terms of price level and PE ratio. Price-earnings ratio, as you can see on this chart, measuring the forward PE ratio for the S&P 500. This chart shows that the PE ratios across equity markets are elevated. The 20-year PE ratio for large-cap U.S. stocks, as represented by the S&P 500, is 15.4. The current PE ratio is about 22.3, 145% above the historical average of 15.4. The PE ratio of large-cap growth stocks is 169% above its average. You can see also for U.S. mid-cap and small-cap stocks that current valuations are high, with growth stocks significantly above their averages compared to value stocks. International and emerging market stocks are less pricey, with PE ratios of 16.9 and 15.1. There are some reasons for the current elevated PE ratios of equities. One significant reason is that low bond yields make dividends on stocks and prospective returns on stocks relatively attractive compared to bonds. That said, any significant increase in interest rates would change the calculus of stocks to bonds, and the PE ratios, and therefore equity prices, could revert towards their historical averages. This could result in a significant sell-off in equity prices. In a market where both stocks and bonds look fully valued to overvalued, where to weight your investment portfolio? As noted, an equity investment with a lower PE ratio means you are buying $1 of corporate earnings at a lower price than an equity investment with a higher PE ratio. So in this chart, we can see that value stocks are trading at PE ratios lower than growth stocks, in particular as percentages of their historical averages. Value stocks, representing companies in sectors such as banks, energy, and consumer cyclicals, sold off during the COVID shutdowns of 2020. As the economy revives and vaccines make more normal activities, such as travel and business activity pick up, these sectors have the potential to deliver strong relative returns to growth stocks, such as tech companies which benefited from the lockdowns of the COVID crisis. This does not mean technology and other growth stocks will not continue to do well with strong economic growth in 2020, just that the rebound in stock prices of sectors beaten down during the COVID crisis could do better. This is what we saw in the fourth quarter of 2020 and so far in the first quarter of 2021, when small cap and value stocks and emerging market stocks outperformed the large cap stocks of the S&P 500, which had led the market during the first half of last year. For example, this chart shows the relative performance of U.S. small cap value stocks to the S&P 500. As you can see at the right-hand side of the chart, small cap value significantly underperformed large cap S&P 500 stocks in recent years. The small uptick you see is the fourth quarter 2020 outperformance compared to large cap stocks. You can see there is considerable room for more outperformance of small cap value stocks for them to return to their historical relative performance to large cap stocks. In this chart, the sharp upward sloping line shows the outperformance of growth stocks driven by the FANG stocks such as Facebook, Apple, and Google compared to value stocks. The slight downturn shows the outperformance of value stocks over the last quarter. If this reversion were to continue, value stocks would significantly outperform growth stocks. No assurance that this will happen, but if you are basing forward expectations on historical relationships, you would want to take this into account. International and emerging market stocks also look relatively undervalued compared to U.S. equities. This chart shows current PE ratios for U.S. equities and international equities and expected 10-year returns based on historical performance. So you can see international equities look to be the more promising buy. So on the equity side, small cap value, international and emerging market equities look relatively attractive compared to U.S. large cap and U.S. growth stocks. Given the relative unattractiveness of investment-grade bonds, given their low current yields, areas we are looking at which have higher yields include alternative credit, such as niche credit opportunities in specialty finance, litigation finance, music and commodity royalties, and trade finance. Green energy infrastructure, revenue streams from commercial and utility-scale solar and wind power energy facilities, which will be supported by the Biden administration's green energy initiatives. Energy infrastructure, such as oil and gas pipelines, storage and transfer facilities. Stocks of these companies sold off significantly in 2020. They currently have yields of around 10% and have been rebounding in price this year. If you are interested in talking further, feel free to send me a note or give me a call. Thank you for watching.